In March of 2008, a 85-year-old investment bank ceased to exist over the course of a single weekend. Its headquarters still stood on Madison Avenue. Its trading systems were still running. Its name was still printed on contracts across the global financial system. But Bear Stearns, once one of Wall Street's most aggressive and influential firms, was no longer considered viable. By the time markets opened on Monday morning, its survival depended on a hastily arranged sale, backstopped by the United States government, at a price that reflected not its past profits but the urgency of containment. The event did not begin a crisis. It revealed one that was already underway. For much of its history, Bear Stearns had been structured around a particular understanding of markets. It was not the largest firm, nor the most diversified. It compensated by being fast, opportunistic, and willing to operate close to the margins of acceptability. The firm specialized in fixed income trading, particularly in mortgage-related securities, an area that had grown steadily for decades and was widely considered both innovative and stabilizing. Housing prices, in the prevailing view, did not fall nationally. Risk, when distributed across enough instruments and counterparties, was assumed to become manageable. This belief was not unique to Bear Stearns. It was embedded in regulatory frameworks, rating agency models, and the internal risk systems of nearly every major financial institution. Securitization transformed individual mortgages into tradable assets. Tranching created layers of risk that could be sold to investors with different appetites. Mathematical models, calibrated on historical data from a period of rising property values, suggested that even severe localized downturns could be absorbed without systemic disruption. Within that context, Bear Stearns' expansion into mortgage finance appeared rational rather than reckless. The firm's business model relied heavily on leverage and short-term funding. It borrowed extensively in the overnight repurchase market, using securities as collateral to finance its trading positions. As long as counterparties were willing to roll those loans each day, the structure functioned efficiently. Liquidity, in this environment, was not held in reserve. It was assumed to be continuously available. Balance sheet strength was measured less by cash than by access. Internally, Bear Stearns was governed by a culture that rewarded assertiveness and speed. Decision-making authority was concentrated among senior executives who had risen through trading desks rather than advisory roles. Risk controls existed, but they operated within assumptions that were rarely challenged. When profits rose, the model was reinforced. In the mid-2000s, the firm reported record earnings. Its exposure to mortgage securities, particularly those tied to subprime lending, generated returns that compared favorably with larger rivals. Concerns, when they surfaced, tended to be addressed incrementally. The first visible fractures appeared in 2007, when two Bear Stearns-managed hedge funds heavily invested in subprime mortgage securities collapsed. The losses were significant, but they were framed as contained. The funds were off-balance sheet entities. Their failure did not, in itself, threaten the firm's solvency. Markets absorbed the news, and Bear Stearns continued operating. Internally, the episode was treated as an anomaly rather than a warning. The underlying assumption remained that liquidity disruptions were temporary and localized. As conditions in the mortgage market deteriorated, uncertainty increased about the valuation of complex securities. Prices became harder to establish, trading volumes thinned. In this environment, confidence mattered as much as capital. Firms depended on the willingness of counterparties to continue providing short-term funding. Any doubt about solvency, even if unfounded, could become self-fulfilling. By early 2008, strains were evident across the financial system. Several institutions reported write-downs. Interbank lending became more cautious. Central banks began to expand liquidity facilities in response to growing stress. Bear Stearns, despite public assurances, was increasingly reliant on confidence that it could not directly control. Its balance sheet remained highly leveraged. Its funding was overwhelmingly short-term. Its assets were difficult to liquidate quickly without losses. The critical shift occurred not through a single announcement, but through a gradual change in behavior among market participants. Counterparties began to ask more questions. Haircuts on collateral widened. Some lenders declined to roll overnight funding. These decisions were not coordinated. They did not require a consensus about Bear Stearns' insolvency. They reflected a reassessment of risk in an environment where information was incomplete and trust was eroding. As funding pressures intensified, Bear Stearns attempted to reassure markets. Senior executives communicated with clients and investors, emphasizing liquidity and capital adequacy. The firm sought alternative funding sources and engaged with regulators, but the structure of its liabilities left little margin for delay. Unlike a commercial bank, Bear Stearns did not have access to stable retail deposits. Its survival depended on continuous market access. The pivot came in the second week of March 2008. Liquidity outflows accelerated sharply. Clearing banks, concerned about their own exposure, demanded additional assurances. Without the ability to fund daily operations, Bear Stearns faced an immediate operational crisis. The issue was no longer long-term solvency but next-day liquidity. Absent intervention, the firm would be unable to meet its obligations. Regulators, including the Federal Reserve and the Treasury Department, confronted a situation for which existing frameworks were poorly suited. Bear Stearns was not a commercial bank and did not fall neatly under traditional lender of last resort mechanisms. Yet its failure threatened to disrupt markets far beyond its own balance sheet. The firm was deeply interconnected through derivatives, repo agreements, and clearing functions. A disorderly collapse risked cascading effect across the financial system. Over a weekend, negotiations unfolded under extraordinary pressure. The objective was not to preserve Bear Stearns as an independent institution, but to prevent a sudden unwind of its obligations. J.P. Morgan Chase, one of the few firms with the capacity to absorb Bear Stearns' operations, agreed to acquire the firm with government support. The Federal Reserve provided a financing facility to backstop a portion of Bear Stearns' assets, an unprecedented step at the time. The agreed purchase price, initially set at $2 per share and later revised modestly upward, reflected the firm's loss of negotiating power rather than a detailed valuation of its franchise. Shareholders were largely wiped out. Employees faced uncertainty. Markets reopened with a sense of containment rather than relief. The immediate crisis had been managed, but the implications were still unclear. In the weeks that followed, attention shifted to what the Bear Stearns episode represented. Some observers viewed it as an isolated failure driven by poor management and excessive risk-taking. Others saw it as an early signal of broader structural weaknesses. The rapidity of the firm's collapse challenged assumptions about liquidity, diversification, and the effectiveness of market discipline. What became evident was the extent to which modern financial institutions depended on confidence that could evaporate quickly. Balance sheets constructed for efficiency left little room for prolonged stress. Risk models, calibrated on historical correlations, did not account for the behavior of funding markets under systemic strain. Regulatory boundaries, designed for an earlier era, proved inadequate when non-bank institutions performed bank-like functions. Subsequent events would eclipse Bear Stearns in scale and severity. Other institutions would fail. Markets would seize more dramatically. Government interventions would expand. In retrospect, Bear Stearns came to be seen less as the cause of the crisis than as its first unmistakable manifestation. The mechanisms that brought it down were already in place. The firm was simply the first to encounter them without sufficient buffers. Narratives that followed often focused on individual decisions or cultural flaws. While these factors mattered, they obscured a more diffuse reality. Bear Stearns operated within a system that rewarded leverage, assumed liquidity, and diffused accountability. Its strategies were extreme but not anomalous. Its collapse revealed how quickly rational behavior under one set of assumptions could become untenable under another. In the years after 2008, regulatory reforms sought to address some of these vulnerabilities. Capital requirements were raised, liquidity standards were formalized, certain funding practices were constrained, yet the underlying tension remained between efficiency and resilience, between market-based finance and stability. Bear Stearns' disappearance did not resolve that tension, it merely made it visible. The firm's name faded from trading floors and financial statements. Its functions were absorbed, its assets dispersed. What persisted was a revised understanding of fragility. The weekend in March did not mark an ending so much as an acknowledgement. The system adjusted, as it often does. What remained unresolved was not the memory of Bear Stearns, but the conditions that made its sudden absence possible.